Start off with you. I thought it was a very interesting survey that you and your team have brought together. But ultimately, what do these 30 managers say is going to lead to the bears to take over?
Well, it's the classic imagery of the punch bowl. You think about central banks, and they provide stimulus and liquidity with the analogy of a punch bowl for the party. And then when things get a little too exuberant, they take the punch bowl away. And most of the strategists and investors that we spoke with point to central banks as the potential trigger for a bear market in both stocks and credit. And if you think that the Federal Reserve this week will be giving us further clues as to when they're going to start shrinking their balance sheet, that's going to start presumably in the next few months. The European Central Bank, probably by the middle of next year.
Maybe the BOJ, 2018?
Well, the BOJ, keep in mind, they are already tapering.
Yes,
they are buying fewer bonds than they were just a year or two ago. So are they going to be raising rates? Probably not, but they are actually providing less liquidity than they once were.
Yeah, the stealth tapering, as we call it. Ajay, you know, as much as the Fed, as much as Fed officials want to talk about how, unwinding the balance sheet is like watching paint dry, most of the people in this survey say that tightening is going to be messy. Do you share that view?
Yeah, if they do tighten, if they do tighten, it is likely to be messy. The consensus view is that they probably shrink the balance sheet starting in September. They have one rate hike in December, possibly 2 or 3 next year. But when they did QE1, they did not tell us they were going to do QE2 and QE3, right? And so I think my view is very different. I don't see inflation anywhere in the world.
So we've taken it too far, you're saying, maybe?
Yeah, I'm not so sure how, every year we come in January and say bond yields are going to go up. We've been doing that for 30 years and been wrong pretty much for 25 out of 30 years. So I think for the Fed believes in the Phillips curve, i.e. unemployment rates are very low, therefore wage pressure should pick up, inflation should pick up. And whether I look at China, whether I look at Europe, Japan, Asia, emerging markets, or the U.S. itself, I just don't see any inflation. It's actually falling. So in January, 90% of developed countries had rising inflation. Today, only 10% do. So I know that Chair Yellen has said this is like a transitory phenomenon. It's been 4 months in a row now that core PCE has been falling. And I'm just wondering that if we get 2 or 3 more declines in core PCE, what is the justification for tightening? And I don't like the word normalization at all. So an 80-year-old or an 85-year-old, the number of push-ups he can do is different from a 20-year-old and a 50-year-old.
Right.
There's no normal level of push-ups. It really depends.
It's interesting, too. I mean, we're going to talk about the Fed, talk about your market strategy, Ajay, a little bit later. But, Chris, we've seen in the survey that people think that stocks as well as credit could actually end up going into a bear market almost around the same time. So where is it most vulnerable? It seems like there still seems to be a lack of consensus on that front, too.
Well, we have a number of people pointing out that valuations in stocks look pretty rich. But the theme that really came across was, as Ajay was saying, about the bond market, that people just feel that bond yields are too low. And if you look at not just treasuries, but you look at emerging market bonds, you look at high yield, premiums are pretty small historically. And everybody kind of agrees that, yeah, there's something out of whack here. But what was interesting was when we asked them what was the one thing that you plan to do to change your portfolio in coming months, almost nobody said that they would get out of the bond market. So they they feel anxious about bond valuations and bond yields and premiums, but perhaps because they've been wrong for so many decades about the end of the bull run, they're actually not shifting out of bonds.